Hey, what's going on, guys? Marcus Bowman here with KU Real Estate Group of Keller Williams. Wanted to hop on and talk to you about the numbers. We get a lot of questions. What's going on with real estate? Is now a good time to sell, or is now a good time to buy? And we do a good job of answering these questions and trying to keep it light without too much technical data. But a lot of times you have to really understand and see the numbers to fully grasp what we're saying. So we wanted to make sure we took the time to give you information, not too technical, but just enough to where it makes sense and it doesn't put you to sleep. So we put together this for you to take a look at. We're just going to talk about some of the numbers, both from a national standpoint as well as from a local standpoint, because it's good to know what's happening nationally, but everybody wants to know what's happening in their backyard. So that's what we have here today. Stay tuned. There's a lot of great information here, and I think I have the best at the end. So stay tuned, but we're going to go through everything here. So we open up the report and we're looking at the Triangle region, just kind of showing you what has happened with home prices in the last 5 years. So we see here in 2020, 338,000 was the average sales price, and we fast forward to 2024. And we are at 483,000 as the average sales price for the Triangle. Now, that represents from 2020 to 2024, roughly about a 42% increase. So that means, on average, if you purchase your home in 2020, it's likely that you've seen an increase of around about 42 to 43% in what you can sell that home for in the market. Now, keep in mind, when we look at the Charlotte region, we see much of the same. 339 to 493, and that represents right around 46%. So that means that home prices on average were 339 in 2020. They jumped up to 493. This is not your actual appreciation. We'll see appreciation, but it's important when we talk about home prices for large area, they move kind of in tandem with what appreciation is doing. And we'll see that a little further. But just 42% in the Triangle and 46% in the Charlotte market is really crazy over a short period of time. But this is one of the powers of owning real estate. And if nothing else that you get from it, if you purchased a home sometime in the past, you get a pat on the back. If you haven't, don't let the news and media deter you from jumping in now, because your timeline only starts once you own a home. So we encourage you to own a home, and we'll kind of talk about why, and the slide really does it. So, in a nutshell, when we look at the slide, one of the things that I want you to really, really see when you look at this is that you need to buy a home, right? This slide goes back to 1990. So, for the last 36 years, it shows you what home prices have done on an annual basis. If we look at the left side of the graph, we see that it started increasing, and that teal line, or green or teal or whatever color it is, it represents a 4% long-term trend line. What that means is that when you look at home prices over a long period of time, they tend to gravitate towards that 4% mark. That's kind of a not too fast, not too hot line, but it gravitates towards it. Now, if you look at the slide, right around from 1990 to about 2001, we can see that 4% was an average, and it stayed pretty much on that. It was right around those years that bankers realized that, hey, real estate is a pretty safe investment, and we're not losing money when we lend to people, so let's lend to more people. And that's when they came out with these different types of loans that made it easier for people to qualify. Your no income verification programs, your ninja loans, all that happened right around that time. And then they got really greedy, and we go into the '04, '05, '06, and we see we got above that trend line as high as 21%. Now, I do want to point out that we're going to, in that '06, '07 timeframe, keep that in mind, because we're going to reference that quite a bit, and I'll show you why on the next slide. But if we look at this, we see right around '02, we popped above the line, and we're above it for 1, 2, 3, 4, 5, 6 years. So 6 years, we are above that 4% trend line, which by and large of itself is not a bad thing, but we went up more than what we should based on what people were doing in the financial sector. So we see when we dip below that, we're now below that in 2009 after the Great Recession. We dip below that line and we're below for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 years that we're below it. And again, keep in mind this 4% line acts almost like a gravitational pull. When you go above it, you get pulled down. But when you go below it, you get pulled up. And what's happened for these years that we were below it, gravitational pull was pulling everything back towards it. We know what happened in 2020 with the pandemic. Interest rates were cut to help the economy. And in 2021, we see that we jumped from 2020 to 21 a large amount, and we're above the trend line for 1, 2, 3, 4 years, including 2024. And when you stop and take a look at the slide, what it really says, number one, if you're buying real estate, buy for the long term. And it's likely that the longer period that you hold your real estate, the more likely that it's going to go up in value. Now, of course, '08, there's times when we dip below that line and different things happen. Again, we'll talk more on that. But by and large, when I look at this slide, I see that, hey, if I'm buying my home to live in, it's likely it's a long-term investment. So it's anything short, it's all but a bet on, the best bet that you can buy. But when we look at this, we see in these last years, in 2022, we're above the trend line. We're only above it 1, 2, 3, 4, and counting 2025, they're projecting that we'll be above it here. That's not a long time to be above the trend line. So when we think about what a price is going to do, if by and large, or barring any unforeseen thing that happens with the economy, any man-made event, it's likely that we're going to be above that trend line. So just remember I said that. All right, so let's move on. We look at home sales, and I put this slide in here because I want you to take a look at what has happened historically, because if we can become a student of history, a student of the past, it would help us better navigate in our present and better prepare for our future. We talked about that 05, 06 timeframe. Point out in 05, we had 7.1 million home sales. 7.1 million home sales in 05. That was the peak. And since then, we've not recorded a higher home sales. Remember, 2005, 7.1. 2005, 7.1. Fast forward to pandemic era in 2021, we had 6.1, right? Still not the second highest. If anything, it looks like it's maybe the third or fourth highest. But still, it was a period that we all remember because it was a crazy time. All right. So we dip after 2021, we go to 5.0 in 22 and 4.1 in 23, and we kind of stay there right in that general ballpark for 2024, 2025. They're projecting we're slightly above. So we'll see. So home sales should be slightly above, but keep in mind 2005, 7.1, and we'll see why when we come back to it. So when we talk about reasons that you want to buy a home, buying a home is one of the safest investments that you can make. And the numbers, the graphs that we're looking at, it shows that. Here we have actual annual appreciation. And we can see if we go way back into the early 90s, we can see that home prices have been steadily going up every year, increases 3.8, 4.6. We see in from 1990 to 2000, that average was 3.9. Then in 01 to 05, that average was 8.9, even though some years we recorded 12.4% annual appreciation. That means that your home in 2005, your home appreciated 12.4% above what it started at. Now, moving forward into '06, we see the Great Depression, and we actually see annual depreciation. And when I look at this slide, we go from 1990 to 2025. That's 36 years. And out of 36 years, we're only seeing 4 years that there was depreciation. So only 4 years we have annual depreciation out of 36 years. Now that to me tells us that, again, real estate is a pretty safe bet. But we look at in 2020, 9.1, and 21, 18.2% appreciation. Those aren't numbers that we can account for, but even if we just look at the averages throughout this whole time period, I think it's safe to say that buying real estate and holding it is one of the safest things that you can invest in. Now let's talk about the appreciation and depreciation and things that happen, because this graph here talks about what has happened historically, and it's kind of put a better connotation about what was happening during that time, because you and I know that we quickly forget what has happened in the past and we focus more on the present. But if we look, remember going back that '06, '07 time frame, we're on the right half of the screen. We see the housing bubble, September '05, where you see that peak at 14.5, and then that drop in February '09, where it's recorded at negative 12.75 depreciation. So again, and this graph goes back even further, we're going back to 1954. So if we look at 1954 all the way up to 2025, we talk about times where the depreciation was 1% or greater. We don't see that very often, but the times where we do see negatives, we see that there was something that man did. In '91, we had the savings and loan crisis. And I know that many of us don't recall or weren't in the market during that time. However, in '91, that was a banking issue that really caused havoc in the financial sector and spilled over into real estate. Same with the Great Recession. Bankers caused that, spilled over into real estate. So we see that. So if you get nothing else from the slide, just understand when it comes to real estate, the times when we see depreciation is because man did something. So I would go out on a limb to say that depreciation is man-made, but in a perfect world where we have supply and demand and the natural forces of the economy, we tend to say that real estate is a safe bet, and we're not seeing a lot of negatives. So I think that's a relatively safe statement, and we'll park it there and leave it. So we talk about inventory, and I put this slide here because I want us to understand that inventory controls or affects prices. When we think about from an economic standpoint, the basic laws of supply and demand. The greater the supply, the lower the downward pressure on prices. When the supply is lower than the demand, that put upward pressure on prices. If we think about, just in common terms, we think about what the Jordan brand. Jordan controls the price of their shoes by limiting the supply that's out there. They have what they call the drops. And I'm hoping I'm saying this right. I'm trying to keep up with the younger generation, but they have the drops where they drop a certain design of shoe, and all of a sudden it's selling out and everybody's trying to get it, and it's scarce. So that value goes up. Yeezy, they did the same thing with the Yeezy, the Yeezy shoes. They would come out, and they would only come out with limited quantity, limited supplies. So therefore, the prices, and everybody wanted them. So the prices, it controlled the market. It works the same way when we think about real estate. If we look at this green line going across the screen, this is going to be a balanced market. When I say balanced market, it means that there's ample supply to meet the demand. When we think about a buyer's market, that means that there's more supply, so you can usually negotiate greater on those prices than when we're in a seller's market. In a seller's market, inventory is low, and the sellers can usually hold out on their prices because they know if this person doesn't buy at that price, there's somebody else that's going to buy, and there are not a lot of options for people to choose from. So therefore, the seller gets to command the prices a lot more and stay firm on them. If we look at what has happened, we go back to '07, we can see that we stayed in a buyer's market for a long period of time. And not a heavy buyer's market, right? It's not super heavy, but we're still in a buyer's market. In somewhere in that 2012 timeframe, we hit that balance market. We stayed in that balance market for a little while until 2019, 2018, 19. We're dipping into a buyer's market. I'm sorry, a seller's market, but it doesn't feel that way because inventory is still at an okay level. Well, when we get down into 2020 and 2021, we hit a heavy seller's market to where inventory was an all-time low, and we know that the prices were going far above list price, and that was just a crazy time. As we move forward into 23 and 24, inventory has been on the rebound and it's coming back. Technically, it's still in seller's market territory. However, it's feeling a little bit closer to a balanced market, and we'll have to stay tuned to see what happens because there are a lot of forces at play. But by and large, we're still in technical a seller's market era, but let's stay tuned and see what happens. Now, when we talk about inventory, I put the slide up here just to kind of give you an idea of where we think we're headed. Again, there are a lot of forces at play in the market, so we don't know for certain. But if we look at January of 23, we see that we started out somewhere right in that, 300,000 range. And then we kind of hit a peak going into the spring market, and then it kind of cools down. So if we look at history, in January 24, we started and then it peaked and then it went down. If we compare January of 23 to January of 24 to now January of 25, we see that inventory each of those years has increased. And that's where we feel like we're headed, with 2025 being a year to where inventory is better. So we may slip into a more balanced market. And I say that, kind of cautiously, because when we go in, once inventory peaks up, if interest rates stabilize or they drop just a little bit to where buyers feel more comfortable returning to the market, we can quickly see inventory go down. Because one of the major things that's happened is that during that 2020, 2021 timeframe, a lot of homeowners refinanced their mortgages, and home buyers and homeowners took advantage of low interest rate, and they locked in those low interest rates. So they're not quick to let those go to move to become a move up buyer or to relocate. So we have a lot of those people holding on to their homes, and the shortage of supply and the interest rates has caused a lot of people to put home buying on pause for these last couple of years. Now we're in a time to where people are feeling more comfortable with the new interest rates being more of the norm, and therefore saying, I put off buying as long as I can. Let me get back into the market and buy. Let's just, I just got to bite the bullet of the higher payment, higher terms, because I need to own, I need to relocate, I need, for whatever reason, to purchase a home. So that's kind of where we are, and that's what's going on. And, we can't talk about the market without talking about interest rates. Everybody's talking about interest rates and where they are. The news has kind of calmed down a little bit, which I think is good because, quite frankly, I think the news, they do a really good job of scaring everybody. And, while it's good for ratings, it's not good for consumer confidence when we're thinking about the economy and what needs to happen. Because let's be honest, when you're in a interest rate environment that's below 5%, it's usually that way because the economy is really bad and the feds are stepping in. They're lowering the Fed fund rates, which trickle over into mortgage rates to boost the economy. And where we were during the pandemic with 3% rates and upper 2% interest rate was really the government throwing everything they had at the market to try to get the economy jump started again. And they did that, which overheated things, and then they had to raise rates to cool them down. So they're doing this fine dance of trying to balance the economy, and mortgage rates, Fed fund rates, which trickle into mortgage rates, play a big part in cooling and heating up the economy. So we'll stay tuned with that. What I wanted to talk about here is when we look at interest rates, we see that going back to the 60s and 70s, interest rates, six interest rate below 6% was kind of unheard of. We didn't see that for a long period of time. That's over 2 decades that we had rates that were above 6%. When we get into, I'm sorry, we didn't see rates that were below 6%. When we get into your 2002 era, that's when we start. The 2003 is when we start to see 6% rates. Now, keep in mind, we talked about '07, '05, '06, '07. If we look at here on the graphs, we'll see that rates were right in that 6 to 6.5% range. And that was during the time where we sold 7.1 million, or there were 7.1 million transactions. So if we look, it wasn't until '09 to where we dipped significantly below 6%. And since then, we've kind of never really returned up until 23. So it's easy to understand how we've gotten accustomed to interest rates in the fives and interest rates in the fours, because for a good portion of us buying homes for the first time, become homeowners, that's when we start to pay attention to rates. And the news, of course, the news was talking about rates, but that's kind of where we get to the point to where we're paying attention, and rates are now the topic of conversation, and they're so low. So understand that in '08, the Great Recession came about, and that's what caused rates to dip. But then we get into 2017 and 2020, they dip further, which makes it harder for us to swallow a 7% rate. And trust me, I get it. I get it. And I know you don't want to hear historical, nobody wants to hear what historical rates were when you're concerned about today. Uh, and we'll talk about that again in a little slide, but I wanted to provide history and context to what I'm going to say, because I don't want you to say they've never been this high, or it's not normal for them to be this high, when in reality, when we take the microscope and we zoom out a little bit, we see really that rates in that 6% range is where healthy economies live. So I know that's not necessarily what you want to hear, and you can thank me later. But we want to be real about where we are. More importantly, I want you guys to prepare for where we're going, because owning real estate is the catalyst for building wealth. We said it 1,000 times, and we're going to keep saying it because we're passionate about it. And we want you guys to own real estate. We want you to own real estate. We want you to become wealthy as a result of owning real estate. And if we sit on the sidelines and make excuses, or even succumb to reality, it hurts us in the future. And we've got generations that we have the ability to impact today. And at the end of the day, that's the goal, right? So if we look at affordability, compared 2024, we at the right side of the graph, we see right now in 2024, the affordability is right around 32%, which means that for someone making the area median income to afford the area median price, it's going to take about 32% of their income to afford that house. And we say that's high. It's high compared to where we've lived in 2012, 2011 to 2022, somewhere in there, when it was down to 20%, homes were a lot more affordable. And that means that, yes, you should have bought during that time. If you did, you get a pat on the back. If you didn't, it's not the end of the world. I bought my first home back in 2000. And at that point, my rate was 8.25. And, in order for me to afford that home, I had to go on the budget. I had to say, you know what? I can't go out to eat as much as I did before I took on this mortgage payment, but I'm willing to make that sacrifice because I believe in home ownership. And that's where we are. If we look at here in 2006, 2005, 2006, when we transacted 7.1 million homes, affordability rating was right at 32% during that time as well. So it's not that we can't do it. It's a matter of changing our priorities and making home ownership a huge priority so that we can do it in 2025. We need to do it because it makes a difference. And we'll talk about going back to where home prices were. If we don't get on the bus at this moment, there is a real chance that you could miss the bus. So hear me out. You will have to likely tighten your belt to buy a home today. But if you tighten your belt and buy a home today, you will thank me 5 years from now. You will thank me 10 years from now. Because the basic law of supply and demand, especially if you're in North Carolina, there are people that are moving into the state. North Carolina is the third highest state in the country for people relocating to the area. So specifically, if we look at North Carolina, that means that the supply of homes is not enough to meet the future demand for homes, which is going to put upward pressure on home prices. So I don't have a way of predicting what home prices are going to do in the short term because they're susceptible to a lot of different things. However, I will tell you that over the long run, home prices are going to go up. And if affordability of 32% of the challenge today, it's a chance that that number may be higher tomorrow. And even if that number comes down, if they lower interest rates and that number comes down, you've got to think about the fact that home prices will likely have gone up. So I encourage you, tighten your belt, buy today, and trust me, you will thank me tomorrow. We talk about gross domestic product, and I'm not going to spend a lot of time here, but the main thing is I want you to understand that this is a measure of all the goods and services that we produce in the US. And a healthy GDP is around 2 to 3%. And you can see by and large, for most of the years, we've hovered in that range, some over, some below, but we've been at a good place. Gross domestic product, again, over a short period of time, this is 14 to 24. We see that, and broken down quarterly, we get a better idea of where we are each quarter. And these are the things that the people that are a lot smarter than me, or they keep track of, and they're mindful of what's happening because this is a huge, huge ordeal for our country. We talk about unemployment. We can see the ebbs and flows. Understand healthy unemployment is between that 4 to 5, some say 5.5 range. As long as we keep that number in that range, that's good. That at 5%, pretty much everybody that wants to work can find a job. When we dip unemployment below that, employers have to pay a lot of money because the employment pool is a lot smaller. But when we get above that, that means that a lot of people are unemployed, and that means they don't have the money to spend. So unemployment is a huge factor for the economy, and it's something that everybody is watching to try to maintain a nice harmony of people at work. So we talk about inflation, and this is one thing I think since the pandemic, a lot of us have paid more attention to inflation because we understand the price of eggs have gone up. Well, it's not just the price of eggs, it's everything. Car insurance is cell phones, different things. In fact, the only thing that really has done well are TVs. For some reason, TVs have not suffered inflation. In fact, some might argue that they're cheaper now than what they used to be. So I don't know the correlation. Maybe pandemic, they wanted to make sure you were comfortable. Don't know. But inflation is something that measures the increase in the buying power of the dollar and things the cost of everyday items. So this is something, again, that 2% is the target rate where they want that at. And we can see shortly during pandemic, right after pandemic time, that it shot up as high as 5 and 7%. So right now we're hovering really close to where we want to be. And again, in 24, so every quarter this comes out, but in 24 we've been in the end of 24 we've kind of inched down there. 25 we're still trending in where we want to be, but let's keep an eye on it because that could change very quickly and be different. Now, I do want to pause and just take a quick moment here because when we think about 2025, we think about what's going to happen with home prices. We're concerned about what's happening with mortgage interest rates. There are certain things that are in play, if you will, that can affect everything that we just talked about. And to ignore those things would do you an injustice because one of these things could actually impact us and cause everything that we're expecting to be upended, everything that we're expecting to change. So we think about the current policies of the administration. They've been somewhat untraditional or non-traditional, and it is something that the market doesn't like unpredictability. And we think about trade policy, immigration, regulation, and fiscal spending. We know that when everybody knows what to expect, then they can plan and anticipate. When they don't know what to expect, it kind of creates a certain amount of anxiety or panic, if you will. So that's at play. The other thing that we don't talk about enough is the propensity for natural disasters. We've seen in Western North Carolina, we've seen the effects of the hurricane and mudslides and different things that have affected so many people in North Carolina and other parts of the country. But North Carolina, I think, was hit very, very hard. We also see the Florida area. We see the hurricanes and the effects of that. We see wildfires both in Hawaii and on the West Coast. Those are things we want to keep our eyes open and stay tuned for because there may be other things that happen that we haven't accounted for that could affect the economy. And those are certainly things to keep in mind. And then lastly, but certainly not least, we've got international conflict. We've got to be mindful that sometimes wars and different things that happen can, even though if it's not in our backyard, it still can have ripple effects that affect us. So we want to keep that in mind that real estate is susceptible to the economy. And when we got different risks, these things may upend or have an effect. So there's been an enormous amount of talk about tariffs and what's going on. So I'm going to breeze through these next 3 slides, but I wanted to at least touch on it so that we can have an idea of what happens when we talk about tariffs. So first of all, tariffs are a tax imposed by a government on imported goods. And some of the reasons for tariffs include revenue, protecting new industries, protecting established industries, and punishing unfair trade practices, national security, and of course, political leverage. So those are kind of reasons that we might have talks about tariffs, or tariffs may be put in place to help with a certain tactic. We've got targeted tariffs and you got blanket tariffs. So blanket tariffs when it's just a tariff on everything, and targeted is when there's certain goods that you're implying a tariff on. So one of the big questions has been who pays for these tariffs? And this slide just kind of gives you an idea of the cycle and what happens. So I'll briefly go through it. Country A levies tariffs on foreign goods from country B. That means that those imported goods from country B becomes more expensive in country A. Then country B retaliates with tariffs because their goods are not being purchased quite the same, and it becomes, in their mind, unfair to them. So country B retaliates with tariffs that causes country A's good to become more expensive in country B. And number five, importers and exporters, consumers in both countries suffer, and overall trade either fails or is diminished, and economic downturn is likely to follow. And then there's calls for the government to step in and to further alleviate the pain that we're all feeling from it. One additional slide that I wanted to share here is just, with the trade policy and tariffs, this is just a quick illustration to show you the revenue from different places and how our government's funded. Back in the 1800s, the tariffs, the amount of money collected from tariffs basically funded the economy, the government. We go into the late 1800s, we see that not only tariffs, but also sales tax played a large part of it. Then we get into the 1900s, where we now have income tax and Social Security. And right now you can see, as we move to the far right side of the screen, that sales tax and income tax and Social Security are really what's funding the government. And that little itty bitty slice of the gold or mustard color down at the bottom is the effect that tariffs have on the government. So it's not necessarily a source for income, but because the government has grown so much that the income received is not going to be a huge amount compared to what it takes to run the government. So just a few more slides that I wanted to share with you guys. Distress sales in the early 2000s, 2005, 2020, we see high levels of distress sale. In fact, if we go back to the early years, we can see as high as 40%. Well, fast forward into 2016, 2017, we can see the amount of distress sales have come down significantly. And part of that is because people have been maintaining their mortgage payments, and home values have gone up. We haven't seen a lot of depreciation. So if people needed to sell their home, they could. When we get into 23 and 24, a 2%, 1%, 2% is still a relatively low number that is not on many people's radar. So I encourage anyone in today. It's not to say that there aren't people out there that are struggling. It's not to say that there aren't people that are having hard times. Just understand, if you own your home and for whatever reason you may have gotten behind on your mortgage payments, please don't allow the bank to foreclose on it, because you have options. And oftentimes you can sell your home and walk away with the check. So it's important for you to understand that you do have options. So if you're facing difficult times, or if you know someone that is, please have them reach out to KU Real Estate so we can talk to them and help them navigate through this difficult situation. We've helped so many families, and we want to continue that, because you did the right thing by buying your home and owning that real estate. Now it becomes an asset that you have. So if you're having hard times, let's talk about ways that we can assist you. Okay, I touched on homeowners insurance. I want to just hit you guys with the fact that because of these natural disasters and claims that have been reported, we see that there are certain parts of the country that are being hit with higher than normal non-renewal rates. And we see people that are, based on the price of home insurance, that it's gone up. We see that there are a lot more people struggling, and that becomes a thing when we think about home insurance in those areas. So keep that in mind, that that's a real thing that's happening. One thing that I wanted to touch on before I get into the really good stuff again was the fact that if we look at first-time home buyers, first-time home buyers have been a staple of the buyer pool for forever and a day. We go back to the early 2000s, 42%, 40% of all home purchases were done by first-time home buyers. When you have that 40% rank of new people stepping into home ownership, that makes for a healthy and balanced economy. Whenever you get into that number to dip below that, that means a larger pool of people are renting for longer periods of time. That means that that wealth accumulation is not occurring. That means that your price for housing is not stabilizing, but is subject to increase as rent goes up rather than having a stable mortgage payment. So, that's another reason that we encourage home ownership. And that's the reason that I'm so passionate and my team is so passionate. Shout out to KU Real Estate, by the way. But that's why we're so passionate about helping people get into homes, because we understand the value of owning real estate. We understand one is shelter, is stability, but it also is generational wealth. And, as we venture to the times where we talk about affordability, we're having a conversation that's quickly shifting from generational wealth to survival. Being able to have that stability that comes with the fixed mortgage payment that doesn't go up every year like rent. Now, for those of you that haven't, I'm going to go ahead and tell you, you should hug your local real estate agent. This slide tells you that for every real estate transaction, the economic impact specifically in North Carolina is about $122,000. This is the reason that during the pandemic, realtors in most counties, most areas were deemed essential workers. It was essential for the real estate community to help people buy and sell homes because it helped the economy. It's essential that when the economy slumps and they want to spur the economy, that they lower interest rate to entice people to buy, because every time a home is sold, that economic impact, as we see in North Carolina, is roughly $122,000. And we kind of below, you see how those numbers are comprised. But everything from the income that's generated from your closing costs, from the closing costs, the attorney fees, the commissions, everything to the actual impact of you going out buying new furniture and different things from owning homes. The multiplier where when you buy your home and you spend money, the money that you spent with this organization or this company, that goes into circulation, and they in turn spend. And then, of course, 1 out of every 8 homes is a newly constructed home. So that math is factored in as well. So I didn't come up with these numbers. Someone way, way, way smarter than I did came up with these numbers. And as we can see, the real estate industry is a vital in the economy. Now, in turn with, again, one of the 1,000 reasons you should buy real estate, we think about household equity. When I talk about generating wealth, don't trust me, don't believe me, but look at the numbers. We see going back to 2000, 5 trillion turned into 35 trillion. When we think about the amount of household equity that's in the US, these are, back in I think it was the 90s, there was the dot-com boom and the dot-com millionaires. Here we have people that have slowly gained wealth just by owning real estate. And if that wasn't enough, boom, look at this. Net worth of your homeowners compared to your renters. Now, I'm not going to bash any renters today. I'm not going to tell you to look at the red line compared to the blue. I'm not going to do that. What I am going to do is say, look at the net worth in 2019 to homeowners compared to the net worth in 2024 of homeowners. This is proof, and this is the proof that's in the pudding. This is what you can see. These are the national numbers that say that homeowners have gained wealth just in these 5 years. From 2019 to 2024, that net worth went up over $100,000 in that very short time period, just in from those that are owning homes. So now, one last thing that I'm going to end with before we go is just talking about the generational wealth transfer. We're in a period of time where we have the baby boomers who have done everything that they're supposed to do. They've saved money, they've invested money, they've amassed this wealth. And when we think about the different generations, they are the ones that have amassed the most amount of wealth when we think about the generations, but they're at a place to where many of them want to transfer that wealth to the next generation. And it's important that we look at this and we're having these conversations, because sometimes it can go amiss from that generation to the younger generations, and having that discussion, because you don't have to wait until there's a death to get an inheritance. There are many people that have amassed wealth that want to provide to their children and their grandchildren today. And there are ways that you can do that and minimize or even eliminate taxes. And what we want you to do is make sure that you're talking to the accountants, you're talking to the people that are, again, way smarter than me. I just want to plant the seed, because of that money, there's a situation or example to where someone with that wealth that want to transfer it can buy a home, or give their son or daughter or grandson or granddaughter a loan to buy that home, and every year forgive a certain portion of it within the IRS codes, to where that money is forgiven. And as it's forgiven, that tax is either delayed or not paid. You're surpassing it. And I want you guys to be aware and to have these conversations. And again, if there's me planting the seed today, if this is something that you're interested in or something you want more information on, I encourage you, reach out. Let's talk about it, because there's countless things that you can do now in real estate that will, one, allow you to build wealth, but then there's a period that you're building wealth. There's a period that you're protecting wealth. But then in the latter part of the equation, there's a period where you want to transfer that wealth, and that wealth you want to transfer while keeping and allowing as much of it to go to the intended party as possible. And there are ways and people that we can put you in touch with that can assist you. But at the end of the day, if you've got a rich uncle or a rich grandfather that wants to help you buy a home or wants to transfer money to you, let's talk so that we can make sure we set it up to where that happens and everybody wins. So if you stayed with me this time, in the words of J. Cole, I really rock with you. I appreciate you tuning in. Let's continue the conversations. If you want this presentation tailored to you and spoken to you, your group, your church, or what have you, let's connect. Let's get out there so we can spread the word and talk about what's important, and let's build wealth, because why not? Right? So, guys, thank you so much for tuning in. Please like and follow. Give me some feedback. Send me an email, respond. Let me know if you like this and if you want to see more of this. I know I went a little fast. It's a lot of information that I wanted to unpack. But again, if you want this or want me, let me know and let's make it happen. So thank you. Marcus Bowman, KU Real Estate Group. Till next time.